The title of the program is Tax Reform, Impact and Opportunities for Small Businesses. Our presenter is Gideon Sanders. He is senior staff with Crowe LLP. A little bit more about Gideon. He's a certified public accountant and currently, as I said, works in the Dallas office of Crowe LLP as senior staff, federal tax and state and local tax. He advises clients on a variety of tax issues, including completing federal, state, and international tax filing obligations on behalf of his clients, primarily regarding corporate and partnership entity obligations. When he isn't doing that, Gideon is involved in the Dallas Regional Chamber of Young Professionals and volunteers with the Dallas Habitat of Humanity and Dallas Humane Society. He completed his Bachelor of Science in Accounting from Southwestern Assemblies of God University and obtained his Master's of Accounting in Tax, Consulting, and Financial Planning from Texas A&M University's Mays Business School. Gideon, I'll turn it over to you.
So the title of my presentation is Tax Reform, Impact and Opportunities for Small Businesses. In our current business climate, tax planning is probably not foremost in most small business owners' minds. There's a lot of more pertinent issues, financial, operational, HR challenges that are a little bit more looming that everyone is facing. However, smart tax planning and a good knowledge of the options that are available to you can actually work to assist in solving those other issues. Taking full advantage of the tax breaks available can increase cash flows and even lower the detriment caused by staffing related issues. As always, throughout any of the topics that I present on in this presentation, if anything seems relevant to you, I highly recommend reaching out to your personal tax advisor to see what options are right for you. So jumping in here, first I have a little disclaimer. Basically says the information provided here is educational in nature and that you should reach out to your tax advisor as far as the application is concerned. A little bit about me, Justin covered a lot of this. I'm a CPA. I'm primarily focused in the manufacturing and distribution taxation of corporations and partnerships. I'm experienced in mergers and acquisitions, and I'm doing more and more of that as of late. I was born and raised in the DFW area. I'm from a little town out west of Fort Worth called Toller, Texas. About 600 people in the town, so you've probably never heard of it. It's 2 blinking stoplights and a gas station. But I went to Texas A&M for my master's degree, graduated in 2017, and I've been living in Dallas for 3 years now, and I love it. I've also been with Crowe for 3 years. Crowe is the 9th largest accounting firm in the US. We were established in 1942 and recently just celebrated our 75th anniversary. We're primarily focused out in the Midwest, but we're expanding into new regions. The Dallas office opened in 2011 with 1 partner, and now 9 years later, we have about 200 employees operating out of the Dallas office and just opened a Houston office. We are a public accounting firm, so we do tax and audit, as well as consulting and technology with a focus in deep specialization. So the agenda that I have put together for today is the first thing I want to do is go into presidential tax proposals. Crowe has a great team out of the National Tax Office in Washington, D.C. That's put together some awesome scorecards going over the tax proposal scorecards for each presidential candidate. Then we'll move into the CARES Act and then some Tax Cuts and Jobs Act updates and highlights. We'll cover briefly some personal income tax items and then jump into some prospective stimulus items. So as we are less than a week away from the election, I thought it would be really timely to discuss these presidential tax proposal scorecards for corporations and individuals. So these are actually in another slide deck. I'm going to pull that up right now. Right. Hopefully you can all see this okay. I know that there's a split screen between my face and this. These will be, okay, awesome. These will be available as well as everything else in the slide decks that Callie will be sending out next week. First off, I want to give a little disclaimer that it's speculated that Biden's tax plan won't amount to much unless the Democratic Party is able to capture more than just the presidency. So keep that in mind. As well, President Trump has not yet put forward an official campaign document regarding his tax proposal. So the descriptions of his proposals are generally from the administration's fiscal year 2021 budget, proposals for additional stimulus, and other ideas suggested by his admin and clarified by his admin. So jumping right in here, at the top of the page, we have Donald Trump would like to lower the corporate tax rate from 21% to its current, from its current 21% to 20%, whereas Joe Biden would raise the corporate tax rate from 21 to 28%, with another stipulation that would require C Corps with over 100 million in book income to pay the greater of normal corporate tax liability, or 15% of book income. Now, that probably won't affect you and your business for a little while, but possibly in the future. And it will have an effect, I think, if passed, on large businesses that may have been carrying net operating losses. They wouldn't be able to use that net operating loss to fully offset their tax. Moving on to deductions, President Trump would like to expand the meal and entertainment expense deduction. As you may or may not be aware, in the 2017 Tax Cuts and Jobs Act, the entertainment expense deduction was completely eliminated, and those are no longer deductible whatsoever. So it would seem to indicate that he would like to either reverse that or expand on the current deduction. He would extend the 100% bonus depreciation, which is scheduled to phase out in 2023, retain the current R&D development deduction, and establish additional tax deductions for small businesses in order to help them rebuild after the pandemic. Now, as I mentioned, President Trump hasn't yet put forward an official campaign document, so there's not a whole lot of details as far as what those tax deductions would actually be or how they would look, but apparently there is some plan to do something in that regard. Biden, on the other hand, would like to eliminate deductions for expenses to advertise prescription drugs, increase depreciable life of rental real estate, which, if you don't know, the current life of rental real estate is 27.5 years. So increasing that would, decrease your yearly depreciation expense deduction. He would eliminate the deferral of capital gains from like-kind exchanges for real estate, and establish incentives for opportunity zones to profit with non-partners. Now, in the international section, this is where I think personally that some of the more impactful items are happening, aside from the potential raise in the corporate tax rate. Both candidates have plans to either keep businesses and profits operating in the US, keep jobs in the US, or to encourage those who have already left the US to come back. So on the international front, Donald Trump would like to enact a 10.5% tax rate for companies that bring US supply chains for medicines and related products back to the US. Biden, on the other hand, would enact a 10% offshoring surtax for US companies that are shifting profits offshore. He would double the global intangible low income tax rate, which is referred to as GILTI, and then implement anti-inversion regulations and penalties. An inversion would basically be where a large US company purchases a smaller foreign company and merges with it, and then through that merger, they are able to establish their tax base in that foreign country. And then deny deductions for moving productions and jobs overseas, and a few other things in that manner. Tax credits, it's essentially the same game here, but via a different method. Donald Trump would establish tax credits to encourage companies to bring jobs back to the US. The same with Joe Biden. He would establish a Made in America tax credit. And then Biden also has a few credits designed to encourage investment in low income or impoverished communities, like the New Markets Tax Credit, the Low Income Housing Tax Credit, etc. But as I said, I think the gist of both candidates' international policies here are to keep jobs in the US, keep profits in the US, prevent businesses from shifting outside of the US, which is something that is speculated could happen if there was a raise or an increase to the corporate tax rate. So that is their corporate tax plans. I would like to briefly go over the individual as well. So starting off at the top, Trump would like to enact a 10% middle tax class cut. And Biden would raise the top marginal tax rate to 39.6 for income over 400K. In capital gains, Donald Trump would index capital gains for inflation. So what that means is that if you have a capital asset, the purchase price of that asset that you're holding would be indexed for inflation, and the purchase price would be adjusted for inflation. And so when you sell that asset, you would pay capital gains tax on the sale price less the difference between the adjusted for inflation value rather than your original purchase price. He would reduce the top capital gains tax rate from 20% to 15%. And then he's floated the idea of enacting a capital gains tax holiday, which would eliminate capital gains tax for a yet to be identified period. And this is one of those things where there really is not a whole lot of information out yet about how that would look or what the period would be. So there's a lot of speculation involved. Biden, on the other hand, would remove the preference for capital gains and qualified dividends on income over $1 million. So if you have a capital gain and you are making income of over $1 million, you're going to be taxed at your normal ordinary rates rather than a capital gain. Deductions wise, Trump would extend the higher basic standard deduction, which you most likely know that back in 2017, the Tax Cuts and Jobs Act basically doubled the standard deduction. It's now $24,800 for married filing jointly, $12,400 for individuals, and that's scheduled to expire in 2025. Biden, on the other hand, would want to limit total itemized deductions for taxpayers who are approaching a certain income threshold. I believe it's $400,000. So yeah, that's the individual tax proposals for each. And then there's one more item that I wanted to go over. This page overall may not be as relevant, but the one thing I wanted to touch on here is payroll taxes, specifically as far as Trump's plan is concerned. We'll discuss this a little bit more in depth later on. But right now, as a part of the CARES Act, there's an option for employers to delay payment of their share of the Social Security payroll tax. Trump's plan is to forgive this deferred portion entirely if he's reelected. As well, according to the presidential memorandum that he put out, I think it was April 8th, the employee portion of this payroll tax can be deferred now as well, and it's speculated that this deferral would be included in the forgiven portion if and when that were to take place. So yeah, that is the gist of the two presidential candidates' tax proposals. If you haven't voted already, maybe now you have a little bit more info to go on, and these scorecards and a couple others will be included in the slides and materials that Callie will send out later next. So jump back over to my other presentation now. All right, so the Coronavirus Aid, Relief, and Economic Security Act, otherwise known as CARES, which was passed back in March. So one of the main items that came along with the CARES Act was its effect on net operating losses. The prior law that was governing net operating losses was the Tax Cuts and Jobs Act. Under that law, NOL usage was limited to 80% of taxable income, which was reduced from 100% under the previous law. And NOLs incurred in 2018 and later years could not be carried back to earlier tax years, but they did have an indefinite carry forward period. Under the CARES Act, however, there is now an NOL deduction allowable for 100% of taxable income for tax years beginning before 2021. NOLs generated in 2018 through 2020 tax years can also be carried back to the previous 5 tax years, and that indefinite carry forward limit still applies. So basically what happened here is the CARES Act temporarily removed some of the limitations on NOL usage, which were created by the TCJA. That ability to carry back NOLs generated in 18, 19, and 20 is especially going to be useful for taxpayers who may have been taxable in 2018 or 2019 that now find themselves on a loss in 2020 as a result of COVID or any other reason. An opportunity for a carryback claim or an amended return could present an option for increasing cash flows by carrying back those NOLs to offset tax paid in those years and generate a refund opportunity. So definitely discuss with your tax advisor if you think any of that may be applicable to them. The next item is called the pass-through entity excess business losses for individuals. Now, what this is a limitation on the amount of business losses that you as an individual can take on your personal 1040. Under the TCJA, the deduction for current year business losses, which are incurred by a non-corporate taxpayer, couldn't offset more than $250,000 for single, $500,000 for married filing jointly of income from other sources. So income from other sources would include, salaries, self-employment income, interest, dividends, capital gains, etc. And any excess losses that were disallowed would be carried forward to later tax years. Under the CARES Act, however, this limitation on business loss deductions is temporarily lifted, and the taxpayer can deduct 100% of business losses arising in 18, 19, and 20. Now, obviously, 18 and 19 tax years are already over. You most likely have filed your tax returns. If not, you probably should. So for 2018 and 2019, amended returns would have to be filed in order to take advantage of this. However, if you, if say in 18, you were limited in the amount of business losses that you were able to take, and as a result of that, you were in taxable income and you were paying tax, then it's definitely something that if you have limited losses from past years or the current year, that you'll want to reach out to your tax advisor and see if there's something you can do here to take advantage of that, because there's an option not only to, go back and amend those returns, take the full amount of the deduction that you're entitled to, get the refund on whatever tax you paid, but then there is also potential that you could in fact generate an NOL carryback as a result of that, and then carry those NOLs back to previous years within that new 5-year limit, and get some tax that was paid in prior years back as well. So definitely discuss with your tax advisor. That's going to be something that I say a lot throughout the course of this presentation. Moving on, Section 163J, business interest expense limitation. This is something that I'm going to briefly touch on. It may not be applicable to many, if any, of our participants today, but it is something that if you and your business are expecting or planning for rapid expansion over the next few years, that you should be aware of. This is generally applicable to taxpayers with average annual gross receipts of 25 million or more for the previous 3 years. And once you get going, in my experience, I found that clients grow pretty rapidly in this stage, and you can hit that 25 million pretty early on, even if you're not expecting it. What this is a limitation on the amount of business interest expense that you can actually take. I've had so many clients that since this was enacted, would otherwise have been in a taxable loss, generating a net operating loss. But then this Section 163J kicks in and limits their interest expense they're allowed to take, and sometimes throws them back into taxable income in the millions. Under the old rules, TCJA, interest paid or accrued was only deductible up to 30% of adjusted taxable income, which is considered ATI, and that is just it's a different method of computing taxable income. We won't go into it today. It is a little bit complex, but 30% of that amount was what would be allowed as your limitation. Under the CARES Act, that amount is increased to 50%, and you can elect to use your 2019 ATI for 2020. Special rules do apply for partnerships. So just something to keep in mind as you're growing, planning, that this could become relevant to you moving forward. So you need to have a good grasp on what it is and when it will become applicable. One other quick thing that I wanted to say about this is the final regulations for 163J were passed back in July that changed a few things from the initial proposed regs that most tax preparers would have been operating on. In that were amortization of financing fees, so debt amortization fees were included in the definition of interest expense. So those debt fees, debt amortization fees, whatever you want to call them, were included in whatever interest expense was actually being limited and wasn't separately deductible. After some pushback from towards the IRS from commenters on the regs, that is no longer the case, and those amortization of financing fees have been removed from the definition of interest expense. So If by chance this is applicable to anyone in the audience today, it might be worth at least a conversation with your tax provider to find out, how was this done in previous years, and is there an opportunity for some sort of change? We had one client that we were evaluating the effect of these final regs, and it turned out that we were going to be able to save them close to $100K in actual tax as a result of just implementing the final regs over the proposed regs that were initially being used. So the CARES Act does provide several opportunities to help employers retain their workforces and provide paid leave during the COVID-19 crisis. And I wanted to touch on a few of those today, the first being a payroll tax credit. So this credit is equal to 50% of up to $10K in compensation, including healthcare benefits, which are paid to an eligible employee during March 12th through December 31st of 2020. This credit is available to employers whose operations have been halted due to a government shutdown order from COVID. And it's also available to employers whose gross receipts have dropped more than 50% compared to the same quarter in the previous year. If you're an employer with greater than 100 employees, you can claim the credit for employees only who have been furloughed or had their bonuses reduced. But if you have less than 100 employees and you meet the above stipulations, then you can qualify for the credit regardless of furloughs or hours reductions. So definitely something to keep in mind and ask your tax advisor if it's right for you. Another item is the payroll tax deferral, which we touched on during the presidential tax proposals. The CARES Act enables employers to delay payment of their share of the Social Security payroll tax, which is 6.2% of wages. You can, as a business, pay this tax back over the next 2 years, the first half being due December 31st, 2021, the second half being due December 31st, 2022. As we mentioned, though, Trump has speculated that if reelected, he would work to forgive this portion of the payroll tax deferral, which has been deferred. Also, as of August 8th, via a presidential memorandum, there is an option to defer the employee portion of Social Security taxes as well. However, there are still a ton of open questions here, not a lot of answers and not a lot of explanation on how this will work. As I said, it was done via presidential memorandum rather than any official law or act. So definitely discuss with your tax advisor before making any decision here. And then one additional COVID-19 relief for employers I'd like to discuss is the paid leave credit. So under the Families First Coronavirus Response Act, employers with less than 500 employees are required to provide paid leave in certain COVID-19 related situations. So employers that are subject to this can generally get a federal payroll tax credit for 100% of that qualified paid leave as a result of the Families First Coronavirus Response Act. That credit is in the form of up to $511 per day if the leave is taken for the employee's own illness or quarantine, and $200 for leaves taken to care for others. Additional rules and limits to apply to these breaks, and it's possible that any and all of the breaks that we've discussed here could be changed in the following day, next week, next month. So as always, check with your tax advisor for the latest information, because as I said, this landscape is constantly changing and it's impossible to keep up with it all on your own. All right, so the Paycheck Protection Program. This is something that was enacted back with the CARES Act back in March under the Small Business Administration with about $350 billion in funding. Eligible borrowers under the PPP program could receive 2.5 months of payroll costs with a max $10 million loan and could obtain forgiveness based on several criteria. Now, the deadline for applications here was August 8th. However, it is widely speculated that additional stimulus, if passed, would extend the program and add funding, and we will discuss that a little later on. I did, however, want to discuss the loan forgiveness determination rules in case any of you did receive a PPP loan in the course of your business, just so you're more aware of exactly what has to happen here in order for you to actually have that amount forgiven. So if a loan was received, there are really four separate requirements to determine loan forgiveness amount, which must be satisfied over the covered period. So the first one, which I want to mention, is that bottom bullet point. And this is that funds must be spent on allowable buckets only to be eligible for forgiveness. That's payroll, mortgage interest, rent, and utilities. And certain stipulations here do apply. But if all of the loan amount is spent on those buckets and the following three criteria are met, then the entire amount of the loan could be eligible for forgiveness. So those other three criteria are, if you meet that first requirement, then the next thing you want to look at is to make sure that your use of funds is correct. 60% of your PPP loan funds must be used on payroll. As well, there's a maintenance of headcount rule, which means that your average full-time equivalent employees can't drop within the covered period. And if it does drop, then there are certain things that must be done in order to prove that you've at least attempted to rehire whatever employees are no longer with you. As well, the final requirement is that no reduction beyond 25% in average wages of protected employees can take place. And a protected employee is those earning up to $100,000 annualized in 2019. Back in June, there was the Paycheck Protection Program Flexibility Act of 2020, which changed several things about the original bill, which was included with the CARES Act back in March. The changes included an extension of the 8-week cover period to 24 weeks, reduction of that 75% payroll cost down to the current 60%. It extended the rehire safe harbor date and expanded the requirements for rehire safe harbors, extended the 2-year loan term to 5-year minimum for new loans, and then a couple other additional smaller things. The last information I wanted to give you about PPP loans is this. So if a PPP loan is received, other credits and relief provisions may not be allowable. The employee retention credit, for instance. So before, I suppose since the deadline is already passed, what is done is done. However, if additional stimulus is passed that extends this program and increases the funding here, and you have the opportunity to get a PPP loan, then you'll want to make sure that you're doing what's right for you and your business. So make sure you talk to someone who is aware of everything that is applicable to your business so that the best determination here can be made, because you don't want to rule yourself out of something that would help you more by jumping into something else. The next item is that PPP forgiveness is tax-exempt income. However, the IRS has indicated that no deduction will be allowed for expenses giving rise to PPP forgiveness. Now, this essentially reverses the tax-free benefit of being able to exclude that loan for the forgiveness amount. That does not appear to be the congressional intent of the PPP loan forgiveness program. However, no law as of yet has been passed to fix this. Will it? Your guess is probably as good, if not better than mine. We'll see what happens next week. Moving right along, the Tax Cuts and Jobs Act, TCJA, this was passed in 2017 and heavily modified a lot of existing law and implemented new ones. One of the most notable aspects here is something you're probably aware of, which is the reduction of the corporate tax rate from 35% to 21%. Since its passing, the TCJA has been subject to several updates, some of which were passed with the CARES Act. And I just wanted to briefly touch on some of the corrections passed here, as well as some of the highlights of the original bill, which you as a small business owner should probably be aware of in your tax plan. The first item is qualified improvement property, otherwise known as QIP. Prior to the TCJA, qualified retail improvement, restaurant, and leasehold improvement property was all depreciated over 15 years under the Modified Accelerated Cost Recovery System, otherwise known as MACRS. The TCJA classified all of these property types as QIP and intended for it to have a 15-year MACRS recovery period, which would allow it to be fully depreciated under that 100% bonus depreciation rule, which, if you're not aware of what that means, 100% bonus depreciation would mean that if you place an asset into service with a 15-year life, rather than getting 1/15 of a deduction for that depreciation on that asset every year, you would be able to immediately expense 100% of the value of that and get the full deduction in the year it was placed in service. However, due to an omission in the language of the TCJA, QIP was defaulted to a 39-year recovery period, which made it ineligible for bonus depreciation, and meant that instead of that full deduction for the whole value of the asset, you get 1/39th of it each year for 39 years. So the CARES Act included a technical correction to fix this error retroactively, meaning that 100% bonus can be claimed on qualified improvements during the past 2 years. Now, this change will most heavily affect asset-heavy taxpayers, especially if you placed a lot of qualified improvement property in service over the past 2 years. And if you were not in a loss during those years. It's highly recommended that if those facts and circumstances fit the description of your business, that you speak with your tax provider and find out, okay, what should we do here? What is the right path in order to recoup the extra depreciation and fix this, so you don't have to wait 39 years to get the full benefit of whatever assets you place in service during that period. Moving on, the Section 199A deduction for pass-through entities. This is a rather complex item, and it contains a lot of elements outside of the scope of today's presentation. However, it is a really important concept for small business owners to be aware of, as most, not all, but many small business owners are operating pass-through entities, such as a single member LLC or a partnership. So if you want a more in-depth explanation, you're welcome to email me after this or reach out to your tax provider to see how it's affecting you. But I will briefly cover it here. So under the TCJA, there was something called the Section 199A deduction for sole proprietorships and owners of pass-through entities. This is a deduction that is generally equal to 20% of QBI, which is qualified business income, and it's phased out at different income levels. Fully limited if your taxable income exceeds $213K, or $426K if you're married filing jointly. Now, that qualified business income is generally defined as the net amount of qualified items of income, gain, deduction, and loss, which are effectively connected with the conduct of U.S. business. Makes a lot of sense, right? There are a lot of things that go into this, including some very technical calculations. So definitely not something I'm going to go into now, but if it is something that you're interested in having a better understanding of, feel free to reach out to me or reach out to your tax provider to see how it's affecting you. I also wanted to go over a few miscellaneous deductions, which were enacted under the Tax Cuts and Jobs Act. So under the Tax Cuts and Jobs Act, employer deductions for providing commuting transportation to an employee are no longer deductible. It also eliminated employer deductions for employee transportation fringe benefits, such as parking allowances and transit passes. These are still tax-free to the recipient employees, though. I do also want to mention that transportation expenses for actual business-related travel are still 100% deductible. It's just those expenses that are related to employee commuting or providing parking for your employees, which are no longer deductible. Parking expenses. So this is something that, in my opinion, is one of the most pointless things that came from the Tax Cuts and Jobs Act. Essentially here, parking expenses are no longer 100% deductible and have to go through a complex evaluation. It is honestly, in my opinion, absurd, the amount of evaluation that has to go into determining an employer's deduction for parking at this point. You may find yourself in the next few years going out and having to count the parking spaces that you have. We have to do an evaluation of how parking is tied in with leases. It even goes into whether or not there's signage available indicating that certain spots pertain to certain employees. And 9 times out of 10, this disallowance is completely immaterial. So it's a little silly in my opinion, but it is one of the things that is included and required by law at this point. Next, there are entertainment expenses, which we briefly touched on in the tax proposal plan. Under the TCJA, entertainment expenses are no longer deductible. Before TCJA, these were limited to 50% along with meals expense, but that's no longer the case. And I have a couple examples here. I'll probably go through 1 or 2, but if you are concerned or want more info about this, how this actually works, then feel free to come in here and once you get the slides and sort of reference these examples to see how it works. Essentially what we have here is that, entertainment expenses and meals expense are oftentimes tied in together. For instance, I think one of these examples is taxpayer invites an associate to a basketball game and they purchase tickets to attend the game in a suite where they have access to food and beverages. The cost of the tickets, as stated in the invoice, includes the food and beverages. So the basketball game is considered entertainment and cannot be deducted as such. But because the cost of the food and beverages is not separately stated, you don't get any deduction for that as well. So the full price of whatever was paid for this would be completely non-deductible. So this concept is something that, as you're building your business and you're building your brand and you're taking out potential customers or vendors to schmooze, if you will, that you need to be aware of if you want to get the most deduction possible, especially if that's something you're doing on a routine basis. Try to plan in a way that allows the entertainment expenses to be separately broken out from meals expense, because otherwise 100% of it will be non-deductible. Moving on. So I'll briefly touch on some personal income tax items. And as I said, I know most small business owners are operating pass-through entities, so a few of these may be relevant. As we discussed, the Tax Cuts and Jobs Act nearly doubled the standard deduction for each filing status. The 2020 deduction will be $12,400 for single, or $18,650 for head of household, and $24,800 for joint filers. In addition to doubling the standard deduction, the TCJA also limited or eliminated a lot of itemized deductions from the past. So if you itemized deductions for years and years and years, you may find that it's actually impractical to itemize going forward. A few of the examples of limited or completely eliminated itemized deductions are property tax deduction, limited, state and local tax deduction, limited, home and equity debt interest deduction, expenses relating to working at home if you're an employee. All of these and many more have been either limited or eliminated. So the combination of the difficulty to actually itemize deductions in a meaningful way that would be greater than the standard deduction you could take, and that combined with the fact that the standard deduction is now so high will ultimately most likely put you in a position where it makes more sense to just take the standard deduction. And that does have the net effect of simplifying your tax return filing process, as there's less of a need to collect receipts and figure out all your deductions and keep track of that in that way. But definitely talk with your tax advisor and determine what's best for you. Charitable contribution deduction. Now, this is something that would generally be fully deductible on your personal tax return, but only if you were to itemize deductions. And as we just discussed, oftentimes now that is not going to be the most prevalent route for you to take. The CARES Act, however, I guess in an effort to increase contributions to charitable causes, is allowing taxpayers to claim the standard deduction and then still deduct up to $300 of cash donations. So you don't have to itemize in order to get this deduction. You can at least deduct $300 of whatever cash donations to qualified charities, even if you just take the standard deduction. Retirement plan owners. Now, this is something I really want to stress. Early withdrawals from retirement accounts should be a last resort. But if you're posed with a difficult choice and you really need that money, the CARES Act does provide some relief and some options here. So under the CARES Act, if you own a retirement account and you need those funds to survive financially as a result of COVID, then you can withdraw from your retirement accounts without being subject to that 10% early withdrawal penalty. If you take a distribution, that can be then recontributed to your retirement plan over a 3-year period, starting the day after the withdrawal. However, if you do not plan to recontribute that money, you will have to pay income tax on that amount. But those payments can be spread out over 3 years as well. Now, there are, when I say a lot of additional rules apply, I've said that 5 or 6 times. This is one where a lot of additional rules apply. So please, 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 as I said, this should be a last resort, but definitely if you were ever going to talk to your tax advisor first, do it before you do this. And I wanted to briefly allow you guys to check out the 2020 individual income tax brackets. So this is what the adjusted for inflation tax brackets are going to look like. Moving right along, prospective stimulus. As you know, additional stimulus is currently stuck in Congress, and at this point, I believe Congress has been dismissed until after the election, so there's no hope of another stimulus bill coming through. However, based on what has been presented in presentations from proposals rather from both sides of the aisle, there are several things that we can fairly confidently say will probably be included in whatever stimulus bill is passed, if any. So the first of those is the Paycheck Protection Program extension and additional funding. This has been included in almost every single proposal put forth by both sides of the aisle. So if and when something else is passed, we can pretty confidently say this will be included. As well, stimulus payments, proposals from both sides have included another round of checks for up to $1,200 for individuals who meet the income requirements, as well as potential aid for airlines and enhanced unemployment insurance. Now, I'll say again that all of this is purely speculative, but I think that we can, at least on the first 2 items, pretty confidently say that some form of these first 2 items will be included in whatever additional stimulus is passed. However, I have no idea when or if that will be. So in conclusion, there are a ton of avenues for you to get the assistance that you and your business need in order to weather this storm. Between the presidential tax platforms, COVID-19 relief efforts, and ongoing updates and corrections to existing tax law, the landscape of business and personal taxes is constantly changing. Much of what we discussed today could change tomorrow or the next day or in the coming months. It's always a good idea to talk to someone who is a business expert and a trusted business advisor that knows your situation, knows the situation of your business, so that they can give you the best advice possible. Tax planning up front can oftentimes save a lot of unforeseen dollars and headaches down the road. And right now it can even potentially provide you with cash flows that you need to help keep your business up